This Time is Different, 8 Centuries of Financial Folly, by Carmen M. Reinhart and Kenneth S. Rogoff. This is a book summary. They said the rules had changed, that this wasn't like the last time, that new technology, smarter economists, and cleverer governments had finally tamed the beast, that financial meltdowns were relics of the past, confined to black and white footage and dusty textbooks, that this time was different. But it wasn't. It never is. In the 14th century, mighty Florentine banks lent lavishly to kings and watched their fortunes vanish in a blink when England's Edward III defaulted. In the 18th century, France, the most powerful kingdom in Europe, defaulted 8 times before the revolution even began. And in the 21st century, the world's most advanced economies brought the entire global system to its knees again. This Time is Different, 8 Centuries of Financial Folly by Carmen Reinhart and Kenneth Rogoff is more than a book. It's a warning, a diagnosis, a mirror held up to the very nature of human behavior under the illusion of progress. Reinhart and Rogoff poured over 8 centuries of data across 66 countries, documenting crisis after crisis. Sovereign debt defaults, banking collapses, currency crashes, and bursts of runaway inflation. The names changed, the flags changed, but the patterns? They never did. This is their story, and this is ours. Chapter 1: The Big Illusion. Let's get one thing straight. Financial crises are not rare. They're not black swan events. They're not acts of God. They are baked into the system, not a bug, but a feature. Reinhart and Rogoff call it the This Time is Different syndrome. The belief, clung to by bankers, economists, and politicians alike, that our era is special, that this time we've mastered risk, that we've evolved past the mistakes of the past. It always starts the same way. A country grows, optimism blooms, investment pours in, banks loosen lending, governments borrow more, convinced the good times will last. Households do the same. Credit cards, mortgages, margin loans. Debt becomes invisible, just another part of life. And like a party that goes on too long, everyone keeps dancing, not because they think it's safe, but because no one wants to be the first to leave. But beneath the surface, risk is piling up. A slight rise in interest rates, a dip in investor confidence, a rumor, a war, anything. And suddenly the whole thing tips, the illusion shatters, confidence disappears, and the free fall begins. And the most tragic part? We've seen it before, hundreds of times, across 8 centuries, and yet we still say, this time is different. Because believing the lie feels safer than facing the truth. Chapter 2: 8 Centuries of Folly. The year is 1340. King Edward III of England, caught in the spiral of war expenses, defaults on massive loans taken from Florence's 2 most powerful banking dynasties, the Bardi and the Peruzzi. At the time, Florence was more than just a cultural beacon, it was a financial empire. The collapse of these banks didn't just shake Tuscany, it sent ripples across the continent. That was just the beginning. Fast forward 2 centuries. Spain, flush with gold and silver from the Americas, is the richest empire on earth. But wealth on paper masks a crushing reality, mountains of debt. That year, King Philip II declares bankruptcy. He would do it again. And again, and again, in total? Spain defaulted 13 times before the 20th century. According to Reinhart and Rogoff, the reigning champion of sovereign defaults in pre-modern Europe. And France? France defaulted 8 times between 1500 and 1800 alone. Austria too seemed trapped in a near-perpetual cycle of insolvency. In This Time is Different, the authors lay it bare. Sovereign default is not the outlier, it is the norm. They show that virtually every country, even those we think of as safe today, has danced with default. Tsarist Russia, revolutionary China, Imperial Germany, modern Greece. The names and ideologies shift. The debt does not. In Latin America, countries defaulted so often the region was branded with a new term: serial defaulters. Venezuela, Argentina, Brazil, all earning reputations for breaking trust with lenders over and over again. Post-colonial Africa followed a similar path. New nations inherited old debts or piled on new ones too quickly, and history repeated itself. Default became almost a rite of passage. Even the mighty United States wasn't immune. In 1790, just after its founding, it defaulted on Revolutionary War debts. And in later centuries, it chose a quieter route: inflation, a slow, silent way to cheat creditors out of real value. Reinhart and Rogoff's research, spanning more than 800 years, paints a damning picture. That across time and space, debt is the great equalizer. Every empire falls to it. Every economy is tempted by it. And every generation forgets its cost. Chapter 3: Debt, the silent killer. Here's the deadly secret Reinhart and Rogoff reveal. Debt doesn't announce itself. It whispers. During the boom, it looks like a blessing. Debt fuels growth. It funds infrastructure. It creates jobs. It boosts GDP. It gives the illusion of prosperity until it doesn't. The authors compare it to cancer, growing silently, painlessly, until it's too late. And in many cases, it's not even the volume of debt that's deadly, but how it's built. Short-term debt is the most dangerous. Like a game of hot potato, it needs to be constantly refinanced. Lenders must stay confident. But confidence, as history shows, is fickle. A single event, a political scandal, a spike in inflation, a distant war, can spook the herd. And when that happens, it's like a match to dry kindling. Lenders vanish. Interest rates skyrocket. Governments scramble to roll over debt, but find no buyers. Banks exposed to sovereign bonds falter. Then come the capital controls, the IMF bailouts, the headlines, the protests in the streets. As this time is different, shows time and time again, debt doesn't just topple numbers on a spreadsheet. It topples governments. It destabilizes entire regions. And once that tipping point is reached, there's no painless way back. Chapter 4: Banking Crises. Equal opportunity destroyers. Think only poor countries suffer banking crises? Think again. Reinhart and Rogoff are blunt about it. Banking crises are equal opportunity destroyers. They do not discriminate between the powerful and the fragile, the emerging and the advanced. Let's rewind to Denmark, 1813, during the Napoleonic Wars. A modernizing economy with a proud history until the war drained its coffers. The Danish central bank collapsed. The crown lost all credibility. Panic followed. Fast forward to the 21st century, the United States, with the world's largest and most complex financial system, is brought to its knees by a housing bubble and a subprime mortgage scandal. Lehman Brothers collapses. Credit freezes. The Dow plunges. In a matter of days, global finance teeters on the edge of ruin. Japan, crushed by its own banking implosion in the 1990s. Britain, Northern Rock and RBS both required extraordinary intervention. Germany, hit hard by American toxic assets. Greece, Spain, Ireland, all swept into a Eurozone storm that nearly broke the Union apart. Reinhart and Rogoff chronicle crisis after crisis across centuries and continents, showing that no nation has truly graduated from the risk of financial collapse. In fact, the illusion of safety often makes advanced economies even more vulnerable. And here's the kicker: the costs don't stop with the banks. On average, according to the data, government debt rises by a staggering 86% in the 3 years following a major banking crisis. Why? Because the state becomes the lender of last resort, bailing out failing institutions, backstopping credit, stimulating demand. But this rescue comes at a cost: massive public debt. Ironically, the cure often becomes the next poison. The debts taken on to fix one crisis lay the foundation for the next. Reinhart and Rogoff warn us, the fallout of banking failures is not just financial, It is deeply political, deeply social, and dangerously persistent. Chapter 5. Default. By other means. What if I told you default isn't always a dramatic announcement or a missed payment? What if it can be stealthy? The most common weapon? Inflation. Inflation is the quiet thief of wealth. It lets governments repay debts, not with missed payments, but with money that's worth less and less. You still get your paycheck, your bond interest, your pension, but by the time you spend it, it buys half as much. Hungary 1946, the worst hyperinflation in recorded history. Prices doubled every 15 hours. The pengo became so worthless, 100 trillion note wouldn't buy a loaf of bread. In modern times, it's not always so extreme. In the 1970s, the US saw inflation spike above 13%. In Argentina, inflation is a recurring ghost. In Turkey, it haunted the economy for decades. Before inflation, it was coin debasement. Medieval monarchs literally clipped silver from coins, watering down the currency to fund wars and palaces. In the modern world, the method has changed, but the effect hasn't. As Reinhart and Rogoff make clear, default isn't just an act, it's a process. Whether through missed payments, restructuring, or inflation, the outcome is the same. Creditors lose. So the next time you hear, "We're paying our debts," ask yourself, are they paying in money or just in promises made of air? Their data showed that the combination of rising leverage, asset bubbles, and current account deficits had always been a prelude to disaster. But no one listened. Because in the heat of the boom, warnings sound like pessimism. And in modern finance, optimism sells. Wall Street forgot history. We never learn. Why? Because every generation convinces itself that it has solved the problem. That our technology is better, our institutions stronger, our economists wiser. That we finally tamed the cycle. But the data says otherwise. Booms are always followed by busts, credit expands, bubbles inflate, and debt, always debt, is at the center. We ignore history because it's inconvenient, because humility isn't profitable, because acknowledging risk means slowing down, and no one wants to hit the brakes during a party. Yet Reinhart and Rogoff's 800-year journey shows us that financial folly is timeless. Countries may rise, currencies may change, empires may fall, but human nature doesn't evolve as fast as our spreadsheets do. So where's the next crisis? It may be in the shadows of a tech boom. It may be building in real estate. It may already be whispered about behind closed doors. The truth? It's probably already brewing. We just don't see it yet. So the next time you hear someone say, "Don't worry, this time is different," stop, think, and remember, it almost never is.